This high-yield stock pays an 11% dividend and is one of my favorite for reduced risk. That's why it's part of my perfect dividend portfolio. Hey Bowtie Nation, Joseph Hogue here with the first in a new series, helping you build the perfect dividend portfolio and live off your dividends. I'll be covering every dividend type and strategy here, from high yield to dividend growth, monthly dividends, and ETFs. In each video, I'll show you 5 dividend stocks to consider, then reveal my favorite, the stock that's in my dividend portfolio. First on our high-yield stock list is a popular one, AGNC Investment, ticker AGNC, with its 12.6% dividend yield. Not only is AGNC one of the highest dividend yields you're going to find, but you're also going to get that payment every single month. The company is a mortgage REIT, or real estate investment trust. This is a special type of real estate company. Now, these REITs borrow money on the short-term rates, then leverage that up, borrowing 2 or 3 times as much to invest in long-term mortgages. This is the interest rate on the repurchase agreements. That's a special overnight short-term rate that many mortgage REITs use. And you can see here, it's been almost nothing for much of the last decade. They use that borrowed money and the other capital to invest in mortgages with higher rates. So if you take a 5 or a 6% interest received on a 30-year mortgage, minus that near zero rates they're paying on the borrowed money, it's been a very profitable business and a great dividend cash flow. AGNC holds a $61.3 billion portfolio of these mortgages, 91% of that in 30-year fixed terms, and most of that safe agency-backed mortgages. But 2 things you do need to watch when you're investing in these mortgage REITs like AGNC, though, is that book value per share and the net interest spread. Now, book value on the left here is the value of the mortgages the company holds, and you can see that this has dropped consistently since last year as those interest rates increase. Now, the problem here is that higher interest rates mean those old mortgages, and really any bonds, are worth less because they pay that lower rate than the new mortgages. For example, the rate on the 30-year mortgages has doubled from under 3% last year to almost 7% at one point. So anyone holding those old mortgages as an investment, the portfolio just isn't worth as much compared to new bonds or new mortgages. The good news here, though, is the stock is trading for a significant discount to that book value. Here you can buy shares for $11 each, a 12% discount to the actual value of those mortgages held in the portfolio. Now, that discount to book value is always a good place to start when you're buying these REITs. Now, the biggest problem for AGNC, though, and really a problem you're going to find with a lot of these high-yield stocks, is they are no strangers to dividend cuts. For most dividend stocks, cutting the dividend is like putting your mom to work in the coal mines. It's unthinkable. But many of these high-yield stocks, they return nearly all of their profits to investors as dividends and leave nothing back for growth. It can mean a slowly bleeding stock price and a dividend that goes nowhere but down. For example, that dividend on AGNC has been cut regularly 8 times in the last 10 years. You can understand the pandemic cuts, but there are many here when the real estate market was as strong as can be. It's why you always need to check the payout ratios and the dividend coverage for stocks when you buy, something I'm going to show you how to do later in the video. We'll get right back to our dividend growth list, but first I want to highlight a special offer from moomoo, one of the investing platforms I use for its features like earnings calendar as well as before and after market trading. The moomoo app has a lot of powerful tools you'll need to find investments and strategies for returns, and is available for US, Singapore, and Australian users. I use the app for the financial calendar to keep up to date with all the important data, IPOs, and dividends coming up. You can trade stocks, options, ETFs, and even ADRs on this. And I love the paper trading feature that starts you with $1 million to follow your stocks and strategies before considering investing your own money. For US users, sign up to moomoo using the link below, and you're going to get up to 15 free stocks worth as much as $2,000 each with your deposit of $1,000 to invest. That is a free stock just for opening the account, 4 more when you deposit $100 and start investing, and up to 10 more free stocks if you deposit up to $1,000. And for my Aussie mates, Australian users can get up to 110 AUD worth of cash coupons to be used in trading with terms and conditions. Even if you don't think you're going to use the app, use the link I'll leave below and get your free stocks and just try it out. I really like this next high-yield stock for its long-term theme, CVR Partners, ticker UAN, and its 20.5% dividend. CVR is a leading producer of nitrogen fertilizers with facilities in the Midwest and production of 1.6 million tons a year. Grain prices hit records last year, and rising global population is driving that food demand. With arable land used in agriculture falling, that means higher fertilizer usage to increase those crop yields to satisfy that demand. Global nitrogen demand is expected to increase by at least 0.5% annually through 2030 and could go even higher than that. So then I love that long-term trend and how it should support the stock and those dividends. Now, why CVR didn't make it closer to the top spot on our list is another problem you're going to find with these high-yield payers, that volatility in the payments. Here you see those dividends from the stock have jumped up and down. Investors received $2.26 a share last May, then $10 a share in August, but in November the dividend was back down to $1.77 per share. And again, this is something you need to research and just be ready for in those high dividend stocks. It's going to be mostly in these special types of companies like the BDCs, the REITs, and the partnerships that pay out all of their profits each year, so that dividend is going to rise and fall with their profits. It's also why I'm doing a special series focusing on those different types of dividend stocks in each video, so you spread out your risk and get a more consistent and reliable dividend payment with all the stocks. So be sure to join the community. Tap that subscribe button so you don't miss a single episode. Next is one of my favorite high yield stocks and a big part of my own portfolio, Medical Properties Trust, ticker MPW, with its 9.6% yield. MPW is the second largest owner of hospitals in the world, with 442 properties and rare international exposure for a REIT, operating in 34 US states and 9 countries. It has 60% of the portfolio in the US, but also 22% in the UK and throughout Europe. Now, healthcare is one of the few sectors that are going to benefit from that trend in aging. With over $3.8 trillion in healthcare spending just in the US alone, more than half of that goes to hospital cares or physician services. It's a figure that's going to continue to grow, and MPW is going to be right there in the middle collecting rents. Now, the shares did tumble last year along with other REITs on those higher interest rates, but also as Medicare and health insurance reimbursements for doctors just failed to keep up with inflation. That spooked the market on the potential for hospital bankruptcies, but MPW is very much protected from this because the portfolio is spread across and how it's set up with businesses. The company operates on a sale-leaseback basis and absolute net lease strategy. This means it buys properties already used by those longer-term hospitals and clinics, facilities that are going to stay in place forever. Then, as part of the lease, the tenant pays all costs, including maintenance, utilities, and taxes. It's 10 to 20-year leases where MPW does nothing but collect the checks each month. We're seeing very strong hiring in the healthcare sector, with health services adding over 58,000 jobs in January alone. That's more than 1 in 10 of the total hiring for the month, with 11,000 in hospitals. There's still that strong growth in healthcare, and the long-term trend is going to be there to continue to support occupancy and cash flows for medical properties. I'll reveal those top 2 high-yield stocks next, both with double-digit yields, and my favorite for a dividend portfolio. But all you out there in the Bowtie Nation know, I can't just drop a list of stocks in your lap and say, go buy these. I want to get you started on how to analyze these highest paying dividend stocks so you become a better investor. And the very first thing I do when I find a new dividend stock is check its dividend history for growth or cuts. On the moomoo app, you find this by going to the summary on any stock page and scrolling down to dividends. You're going to find the entire history of dividend payments along with increases and decreases. Now, dividend cuts do happen, especially with these high yield stocks, but you still want to find those that don't cut regularly and then increase the dividend when possible. I'll also check the stock for its payout ratio or cash flow coverage and then compare that to stocks in the same industry. Now, the payout ratio is just that dividend per share divided by the earnings or the profits per share for stocks. For REITs, BDCs, and MLPs, you're going to need to use that cash flow coverage ratio like funds from operations. And comparing the coverage ratios against others is going to help you find those stocks with sustainable dividends and those with room to grow their payout. And finally, I'm also looking for an upward trend in the revenue or cash flows on the company's financial statements. A company that can't increase its sales or cash flows won't be able to increase that dividend or might even eventually have to cut it. Another high-yield stock here with long-term growth ahead, USA Compression Partners, ticker USAC, and its 10.2% dividend. USAC does one thing, and it does it very well. The company provides compression services for natural gas producers, allowing the gas to be moved through pipelines. Focusing on just this small part of the midstream component makes USAC the go-to for services and removes a lot of that reliance on natural gas prices. You see that volatility in natural gas prices here, in the red line jumping up and down, but look at the green and the blue bars here, adjusted earnings for the company. USAC has been able to drive stable and growing earnings even in the worst times for natural gas because it's built its business based on that demand, not the price. And demand for natural gas is expected to jump 28% over the next 30 years, with U.S. imports rising more than 5-fold. The world is in a race for liquefied natural gas, and the U.S. became the world's top exporter in 2022. That long-term trend should help support the industry and demand for those pipeline compression services. The company has paid out a consistent dividend of 52 cents per share quarterly since 2015 and returned over $1 billion to investors since the IPO. But my top pick among high-yield stocks, shares of Global Net Lease, ticker GNL, and its 11.2% dividend yield. I like GNL for its more internationally diverse portfolio versus what you usually find with REITs. Most REITs are almost exclusively US focused, but Here you have 309 properties, more than 39 million square feet across the US, Canada, and Europe. Properties have a 99% occupancy rate, which is extremely high, and spread among 138 tenants in 51 industries. So you've got the diversification, not just geographically, but risk is spread out so the crisis in any one industry isn't going to hurt the stock. I also like that 54% of the portfolio is an industrial and distribution segment, a huge growth market for real estate. So here, not only are you going to get that international exposure that's going to spread out and lower your risk, you're also getting the major property types, so you don't have to worry about any one particular, like retail or housing, falling and destroying the cash flows. GNL leases to some very strong credit companies like FedEx, Merck, and Johnson Controls with long-term leases of 10 plus years, so this is a very stable cash flow company. That's driven historical revenue growth of 7.4% a year and supports that strong dividend. Get your free shares on the moomoo app with the link below, or click on the video to the right for a special dividend portfolio that puts cash in your pocket every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.